Ranner, Harris and Chan is a consulting firm that specializes in information systems for medical and dental clinics. The firm has two offices, one in Chicago and one in Minneapolis. The firm classifies the direct cost of consulting jobs as variable costs. A contribution format segmented income statement for the company's most recent year is given below. By how much would the company's net operating income increase if Minneapolis increased its sales by $75,000 per year? Assume no changes in cost behaviors. To calculate the increase in net operating income, we simply need to take the $75,000 increase in sales for the Minneapolis office and multiply it by the Minneapolis office contribution margin ratio of 40%. This gives us an increase in our net operating income of $30,000. The next part says to refer to the original data and assume that the sales in the Chicago office increase by $50,000 next year and that sales in Minneapolis remain unchanged. Assume no change in fixed costs. And we're asked to prepare a new segmented income statement for the company using the above format. Show both amounts and percentages. Again, we're told there's no change in the Minneapolis office, so we can pick up the Minneapolis office information from the information that was given. In terms of the Chicago office, we will have a constant contribution margin ratio and variable expense ratio, so we can pick those up directly from the information that's given. We're told the Chicago office will have an increase in sales by $50,000. This means that sales in the Chicago office in the coming year will be $200,000. That's the original $150,000 plus the $50,000 increase. The variable expenses then in the Chicago office will be $60,000. That's the $200,000 in sales multiplied by the 30% variable expense ratio, which means the contribution margin in the Chicago office will simply be $140,000. That's the sales minus our variable cost. There's no change in traceable fixed costs. They will remain at $78,000. So the office segment margin for the Chicago office will be $62,000. That's the contribution margin of $140,000 minus $78,000 in traceable fixed expenses. On a percentage basis, traceable fixed expenses for the Chicago office will be 39%. That's the $78,000 in traceable fixed expenses divided by the new $200,000 in sales. And our office segment margin on a percentage basis will be 31%. That's the $62,000 office segment margin divided by $200,000 in sales. Or we can take our 70% contribution margin and subtract the 39% traceable fixed expenses. On a combined basis, total sales for the company will be $500,000. That's the $200,000 in sales from Chicago plus $300,000 from Minneapolis. The variable expenses will be $240,000. Again, that's the sum of the Chicago expenses and Minneapolis. And the contribution margin for the total company will be $500,000 minus $240,000, or $260,000. The traceable fixed expenses remain constant, and again, they're just the sum of the Chicago and the Minneapolis office, and they total $126,000, which means the office segment margin for the entire company will be $134,000. That's the $260,000 contribution margin minus the $126,000 in traceable fixed expenses. Common fixed expenses remain constant at $63,000, and that was given above, which means the new net operating income for the total company will be $71,000. That's the $134,000 office segment margin minus the common fixed expenses. On a percentage basis, our sales are 100% of sales. Our variable expenses are 48% of sales. That's $240,000 divided by 500. And the contribution margin then will be 100% minus 48%, or 52%. Traceable fixed expenses will be $126,000 divided by 500, or 25.2%. The office segment margin can be calculated by taking the office segment margin of $134,000 and dividing it by $500,000 in sales. Or subtracting our traceable fixed expenses as a percentage of sales, which is 25.2% from the 52% contribution margin. Finally, we can calculate our common fixed expense as a percentage of sales, and that's the 63,000 divided by 500,000, or 12.6%. And last, we can calculate our net operating income as a percentage of sales, and that will be 14.2%. And that's our 26.8% segment margin minus our 12.6% common fixed expense.